Good morning, everybody.
Good morning.
All right, how's everybody doing today?
Fantastic.
Excellent. Okay, listen, welcome to Commercial 106. We've been through Commercial 101 to 106 today. We've learned a lot of things. We've learned how to do cap rates, learned how to analyze properties. Now, this is a very important part because once your client decides to sell their property, they're going to have to learn how to exchange. Exchange actually defers taxes and gives your clients more money to work with. And we have an expert today, Mr. Phil Antwan on 1031. He's a good friend of our company, and he is really an exciting speaker. So I want you guys to put your hands together for Mr. Phil Antwan.
Thank you, Michael, and good morning, everybody.
Good morning.
Everybody's heard of Wayne Gretzky, right?
Yes.
Famous hockey player?
Yes.
They asked him, they called him the what? Anybody remember? His nickname? He's the master, he's the king, he's the best. And they asked him what was the key to greatness. That's why they call him the Great One. And this is what he said. And this is very important as it relates to your business and my business. He said the key to being great in hockey is to not skate where the puck is, but to skate to where the puck is going. In other words, you got to be there before it does. And when you are there, then you can score. The question is, where's the market going today? I'm on the board of directors for the Escrow Association, and recently, as in February, we had the Los Angeles County come out and speak to us for their forecasts of real estate. They're constantly doing analysis and whatnot, and this is what they came up with. They came up with that their projection is, based on what's happening and where they think the market's going, over the next 10 years, personal acquisitions of personal residence is going to decline, and rents, more people are going to rent. Now think about that. Less people are going to buy homes to live with, and more people are going to rent. What does that tell me as to where the puck is going? I'll tell you exactly what it tells me. It tells me you've got to be working with real estate investors. Because if more people are going to be renting, more and more people are going to be involved in the investment real estate market. Whether it's apartments, condos, single families, 2 to 4, 5 and above, whatever it happens to be. So if I was selling real estate, guess what I would be doing? I'd be getting to know as many people as I can who already own rental properties. Why? Number one, they all own their own home. So if they decide to sell their home, great. If you're just working with homeowners and the homeowner has no need to sell, no need to downgrade, upgrade, transfer, whatever, then ultimately you get nothing. There's no sale because there's no need. A real estate investor doesn't have to have a need. They just have to have an opportunity to make more money. Because that's the motivation. That's the reason why they go into investment real estate. And I'm going to talk about that today. So we're going to talk about what an investor is looking for, number one. Number two, how to create a relationship with an investor. Because the last time I checked, you are not in the real estate sales business. If you are, you will not win. You have to be in the relationship building business with people who are in a real estate. Because the more you can talk about what's important to them and give them solutions and education, the better off you're going to be as far as listings and purchases. Does that make sense? So you really have to approach it in a great way like the Great One did in hockey as to where the puck is going. So let's talk about this. Number one, what's the motivation? The answer is cash flow. Investors buy property so the property will work for them so they don't have to. Now, I'm not a big rent control person. If anything, I think it makes the prices go up faster in some cases. However, whether you're for it or against it, here's the deal. Rents are not going down. They're going to continue to go up, especially if the market is going to be more rental. Units and properties for housing, people who want to live in, is going to be worth more going up in the future. So the bottom line is, they know that, investors know that, because cash flow is what it's all about. This is the number one reason. You work for a commission, right? But here's the deal. If you're working for a commission, and let's say you close one deal a month, you close 12 of them a year, that's great. But an investor knows they're going to get paid every single month. They're going to get a commission based on how many front doors they're renting out. So if they want to get paid once a month, they own a condo or a single family. If they want to get paid once a week, they have to have 4 doors. If they want to get paid every day, they have to have 30 front doors. Does that make sense?
Yes.
And they get to pick exactly how many times they want to get paid. And guess what? Rent's not going down. It's going to be going up. Number 2, what's the next motivation? They want to have their cake and eat it too. They want it to be worth more in the future than what they paid for it. I've been doing this since 1982. When I first got in the market, I was in the title industry. What happened is, interest rates had just dropped, like they have been recently. They dropped to 18.5%. Remember?
85 was 14.5.
And it went down to, in 85, from 18.5 to how much?
14.5.
14.5. And people thought they had died and gone to heaven.
Exactly.
So the whole point is, they want to see the prices go up over time, and that's what happened. Let's rewind to 2004, 2005, 2006. That's when we saw those stated income loans. We used to call them liar loans, because that's exactly what they were. People would state whatever income that they wanted, and to be able to get the loan. Well, guess what happens when you enter in a bunch of people in the market who really can't afford it? 2 things happen. Number 1, the prices are going to go up because there's a lot bigger demand, right? And that's what makes the price go up, demand. It's really the buyer that makes the price go up or down, not the seller. Because the buyer will dictate what the property is going to sell for. That's just the bottom line. And number 2, not only did it create more of a demand, you put people in the market who couldn't make the payments. And then, when the market began to start correcting itself, and there was a crash, people said back in 2008, 9, 10, 11, this is what they said: we will never see a market with values like this ever again in our lifetime. Ever. Well, let's fast forward to today, 2019. That was what, 7 years ago? Prices are higher today than they were in the liar market, in the liar qualifying buyer's market. Does that make sense? Nobody thought it would happen, but this is what they live for. In addition to cash flow, they want it to be worth more in the future, so they're worth more financially. Number 3, they need a tax write-off. Why? Because the more you make, the more they take. Who's they?
IRS.
The IRS? It really isn't the IRS. The IRS is the mafia collection arm of the United States Treasury Department. You never make a check payable to the IRS. You make a check payable to the U.S. Treasury. If you get money back, it comes from the U.S. Treasury. The IRS is nothing but the mafia collection arm. There's also a second one, also called the FTB. Does anybody know what that stands for?
Franchise tax.
The Franchise Tax Board. Congratulations, we live in the state of California. We are now the #1 tax state in the country. Dodgers won again last night. To me, they're #1. Well, not really, but yeah, I root for them. And the bottom line is, California's #1 in the tax end. It's higher here than it is in New York or New Jersey or any other state in America. And they want your money too. And not only do they want your money, because you're going to be making more money in real estate, and that's what happens when you start buying this stuff. But what happens is, they want to take a bigger percentage too. Not just the same percentage, they want to jack up the percentage. I was just recently speaking at a CPA and a enrolled agent group, tax group, and it was very interesting. I made a comment. that 5% of the people pay 50% of the taxes here in California. They corrected me and said, that's not true anymore. It's changed. It's now 4% of the people. When people tell you the rich don't pay taxes, they don't know what they're talking about. Because they're not making the money. You own investment real estate, you're going to pay the taxes. That's the bottom line. But you do have to have a tax write-off. And the beauty of owning investment real estate is you get to do what to it? Depreciate it. That means when you first buy the property, in the year that you acquire the property in, your CPA is going to take the value of the property, split it into two sections: land value and building or improvement value. The improvement value will be depreciated over a series of years. Your CPA does all that work. Your client doesn't do anything. What happens is, if it's residential, they'll depreciate it over 27 and a half years. If it's commercial, it will depreciate it over 39 years. So depreciation does what? Well, it does the same reason why you make a commission. You're going to have a what? You're going to need tax write-offs to do what? The offset amount of taxes you want to pay. You depreciate your car. You write off everything you can. Well, so does an investor. Why? Because the more you make, the more they take. And that's just the bottom line. Doesn't matter what party you are, Democrat, Republican, Independent, they all know that. And that's the bottom line. And the goal is to pay less in taxes. Now, let's summarize. Cash flow, appreciation, tax write-offs. But equity's been growing. Is there a way to diversify the equity? The answer is yes, and it ultimately comes from re-leveraging. Now, I'm going to take the camera here away from this for a second. I want each one of you who are watching on this tape, or for those of you who are here, I want you to look at this. Each one of you own 2 rental properties. All right, each one. Now, each property is the same. It's on the same street. All right? Let's say they're single-family rentals. They're same square footage, same condition, everything's the same. Nothing's different, except for one thing. You bought them in the same year, by the way. The first one, property A, is paid off. No loan. Pretty good, right? Property B has got mortgage on it. Got some debt on it. You with me? Each one of you own 2. And we're talking about these 3 items. Number 1, which property will give me a better rate of income return based on the amount of equity I have in the building? Because they're both different. This one's paid off, this one is not. A, that's paid off, or B?
Rate of return as in percentage or
Yes.
cash flow? Oh, well then it's going to be the one that's leveraged.
The answer is B, almost every single time. Why? Partially taxes,
Capital invested.
capital invested, but there's another reason. A can't charge more rent than B. Even though B is not paid off and A is, A cannot charge more rent for the amount of equity, for the amount of the value of the property. You just can't, because rents are not predicated on equity. They're predicated on fair market value of the structure. Number 2, which property will appreciate faster? The one with full equity or the partial equity? They're the same. So far, the extra equity in A is not doing for me what I had hoped that it would. When I look at it, when I analyze it, when I do the numbers. Number 3, which property can I depreciate faster or depreciate more of? The answer is, they're the same. Except B is actually going to be a little better. Why? Because I have a loan. I can write it off. I can write off all the interest. Well, you say, wait a minute, didn't Congress passed the Tax Reform Act almost 2 years ago that went into effect a year ago last January? The answer is yes. Where you can only, on a new purchase money, you can only take $750,000 of that interest. What about above that? The answer is, doesn't apply to investors. Only applies to your principal residence and your second home, not to rental properties. Number two, well, what about the property taxes and those kinds of expenses? I thought I was limited to $10,000 a year. The answer is true. Your personal residence, your second home, not your rental properties. So both are going to enjoy the benefit of investment real estate, but you still have a what? More of a write-off on the interest. And you have less invested in it, but you can still create the same amount of what? Income coming into the property or rent. Does that make sense? So what's the answer? The answer is A needs to have babies. You need to take some of the equity out of A, whether you sell it and buy more doors that will pay rent, or refinance it to go out and buy more doors. Because if you're trying to make money, you need to spread the equity out a little bit so multiple properties can go up in value, not just one. And you have more doors that the rent's going to go which way, up or down? Up over time. That's called re-leveraging. When I sell the property, the government will, whether it's my principal residence, my second home, or my vacation home, or rental, the government doesn't charge me a tax based on the amount of equity that I have in the building. That isn't how it works. Why? Because I can always refinance the equity out, sell the property and say, I don't have to pay any tax because I've got no equity. The answer is the government says, you know, we stay up all night, we never sleep. We think of situations like this on how to tax you. So we're going to tax you on something that's called a capital gain. And every time you sell a piece of property, your CPA is going to calculate your capital gain. Now, your client CPA or attorney should do this, not you, for them. But you can do it for yourself. But this is how it works. First thing you look at is what did you purchase the property for? The purchase price is called your tax basis. You have to start on a base. And the base is the purchase price of $300,000. Now, if I sold it for $1 million and I bought it for $300,000, the difference is to $700,000, and the government would say that's your capital gain. You bought it for $3 million, you sold it for $1 million, it's $700,000, but it doesn't work that way. In part, but not in whole. First of all, you have to add in capital improvements. So if I put money into the property for things like, some of the things I told you I was doing in my house, upgrading, not repairs, not paint, not carpet, but actual capital improvements like stepping up, remodeling, adding on, better new roof. The government will allow me to, if I put $100,000 into it, they will add what I put in capital improvement to my basis. So if I pay $300,000 for the property and I put $100,000 into the property in capital improvements, my basis is what? $400,000. So $1 million minus 4 is what? 6. So the gain starts to go down as I make capital improvements to the property. By the way, anytime I put capital improvements on a property that's a rental, the government says that you create another layer of depreciation. So you have more tax write-off because you're allowed to depreciate any capital improvement that you put into the property, which is really good. Next, if you're taking depreciation because it's a rental property, the government says since you're getting a benefit out of it, we're going to lower the basis based on how much tax write-off you get, and that's going to factor into this number. Lastly, it's going to be closing costs, the cost to sell the property. Those are non-recurring closing costs typically. That would include commissions, escrow, title, transfer taxes, recording fees, and if you use it's the 1031 exchange and a commodity receipt. So the CPA is going to adjust the basis, so the sales price minus the adjusted basis is going to be the capital gain. And that's what they do, not you. They do it for your client. Now, the next question is, how much is it going to cost? Here's the answer. Number one, up to 20% to the IRS. That means it could be less, depending on your tax bracket. Up to 20% of the gain. Number two, oh, by the way, up to the IRS, the IRS. You put these two words together, what does that spell?
Theirs.
That's right. Number two, anybody know what this is? It's Obamacare. It's the health care program that went into effect when it was passed on the sale of any real estate. You pay an additional 3.8% to the health care program after $200,000 of gain. So the first $200,000 is exempt if you're single. But if you're married, then they exempt at, how much? 400? No, 250. You have to pay the tax over $250,000. Remember when they said we want to make sure to have people help support the program who can afford to do it? That's what they were talking about. Next, you have to pay California, the number one tax state in the country, up to 13%. But don't worry, since your eyebrows went up and what? Don't worry, because our new governor said in the State of the State address, he's going to revisit the tax code. Can I explain to you in English what that really means?
It means your taxes are going up.
That's exactly what it means. It's not going down. 1, 2, and 3 applies to your principal residence. 1, 2, and 3 applies to your second home or vacation. On your personal residence, the government, if you qualify for what they call the 121 principal residence exclusion, will exclude of your capital gain up to $250,000 if you're single, or up to $500,000 a gain if you're married filing a joint return with your spouse. So if you have 5 people who are on title, and all, because you have to live in it and own it for at least 2 years or 2 of the last 5, the government then will say that each one of you gets the exclusion based on your percentage of the ownership of the property, as long as you qualify for it. Make sense? And you can take this exclusion one time every 2 years. On a second home or vacation home, you pay 1, 2, and 3. There's no exclusion because it's not a principal resident. And number 2, you can't do a 1031 exchange on it because it's not a rental. So you pay the 100% of the tax. If it's a rental property or an investment property or a commercial building, something that's used for business or investment, you pay 1, 2, 3, and number 4 kicks in. Number 4 is called the recapture depreciation. Remember the depreciation we were able to write off? Well, the government says, Merry Christmas or Happy Birthday, now give me a tax. I'm going to give you a gift, but when you sell it, you're going to pay me a 25% tax on the tax write-off I gave you. And don't worry, if you didn't take the tax when you were eligible to do it, that's not a problem. But you're going to pay this anyway, whether you took it or not. Because it was allowable for you to take, and it's your problem if you opted not to take it. If you were eligible for it. Folks, I don't make this stuff up. 1, 2, 3, and 4 is for your rental or business use property. So the big question is, what is a 1031 exchange? A 1031, what's that word say?
Deferred.
What's this word say? What does that mean? Is it free? People call me up and say, I want to do one of those tax-free exchanges. It's not free, folks. It's, well, your mattress is free. No. It's tax what?
Deferred.
Deferred. What does that mean?
Pay later.
Pay later. Later when?
When you decide to sell the asset
And not do another
and
exchange.
not do another exchange.
It's a deferral of capital gains taxes. And what it means is if you are capable of taking a listing and selling the property, and if you are capable of helping a buyer buy a replacement property, you're capable of helping your client do a 1031 exchange. Because that's all it is. It's taking a listing and sell, it's taking them to go buy a replacement property, and we'll go into more details on that. That's all a 1031 is. For what reasons? For the deferral of what? Capital gains, but it's more than that. And I don't want you to lose this, because this is really, really important. The key is not just the deferred tax, but it's to buy better income producing properties. It's to re-leverage the equity that's grown in your portfolio, so now you won't be stuck as property A. You're going to become more like property B. A has to make babies and buy more properties. Does that make sense?
Yeah.
And that's the point. That's the whole purpose of the exchange. So which properties are eligible for the 1031 exchange? Only 3. Income producing or business use, like a commercial building, a warehouse. I just recently took an exchange in Downey. This guy has a big trucking firm, a big, small office on there, but they house a lot of the trucks. It's business use. It qualifies for the 1031 exchange. Or rentals, like income, or investment, like vacant land. Generally speaking, flipping is not involved in this. This is buying to hold it over time, vacant land. So that's what is eligible for an exchange. What is not eligible? Your principal residence. But you do have the 121 principal residence exclusion that we just went over, up to 250 or up to 500. Your second home never qualifies as a 1031 exchange, but you can convert a second home into a rental, and after 2 years, you can exchange it and defer the payment of capital gains tax. Or number 3, flipping. Why? I just talked to somebody on the phone when I was in the parking lot. They want to do a 1031 exchange on the property they're flipping. Why does the government say, generally speaking, no? The answer why they say no is because you never put it into for rent. You just bought it to fix it and sell it. That's not holding as an investment. And that's their opinion, and guess who makes the rules? They do. So the bottom line is, flipping and developing, generally speaking, does not qualify. Now the government says you have to go back into a like-kind property. It has to be like-kind. So if I'm selling a condo, and it's gone up with an equity, and I want to do a 1031 exchange, but I want to buy vacant commercial land. Can I do that? Is that like-kind? The answer is, right again. The answer is yes. Because the definition of like-kind is not residential to residential. It's not commercial to commercial. It's not improved property to improved property or vacant property to vacant property. It's investment real estate into investment real estate. So you don't have to go back into residential. As long as you're going to buy or hold for investment, like that slide couple I just showed you, held for business use, held for investment use, or for income use, it qualifies for the 1031 exchange. You can mix and match. And you could even take it to any state in the country. So if you're sick of California, you want to go other places, you can do so. You can buy any kind of investment real estate in Alabama. Put the banjo on your knee. No. Or you can buy in where else? New York, Hawaii, Texas. What's really hot right now? Tennessee's very hot. Idaho is very hot. Parts of Texas are very hot. Parts of Nevada are very hot. It just depends on where you want to go. The government will let you take your money anywhere in the United States. Isn't that cool? So how do you set up a 1031 exchange? Does everybody have one of these?
Nope.
Maybe we can take these and pass them around for our viewing audience. We can email this to you. It looks like this. Thank you, Michael. You have to put in your RPA that your seller is doing an exchange and that the buyer is going to cooperate. Now, my recommendation is when you first get a listing, first question you've got to ask the seller is, why are you selling the property and what do you plan on doing with the equity? Why do you ask those questions? Because you're nosy? Well, maybe. But the bottom line is, The reason why you're gonna ask that question is because you wanna find out, especially if they have a tenant in the property, if they're planning on doing a 1031 exchange so they don't have to pay all the capital gains taxes. And then number two, you're gonna ask them that question because you'd like to find them the replacement property. So, Michael, Leonard, maybe you can answer. Isn't it true in this office that 2 commissions are better than 1?
Correct.
That's what I thought.
Correct.
That's not my check.
That's what I thought. Isn't it? You cut the checks. So the bottom,
Better than one.
yeah. So the bottom line is you want to ask the question, why are you selling? And what do you plan on doing with the funds? Because many of them who are selling investment property are going to do what? Releverage to bigger, better properties, right? Isn't that what you and I just talked about
Yeah,
a few minutes ago? So the bottom line is you need language in your, in your agent's remarks, when you put it in the MLS, that the seller's doing an exchange, that the buyer's going to cooperate. But you should use, when the RPA, you're going back and forth on
Counter.
countering, thank you. Use the zip form. You know what the zip form is called on your CAR website? You should write this down so you don't forget it, because it's easy to forget. It's called seller's intent to exchange. Seller's intent, if you put down 1031, it will never show. There's a language in that zip form for the seller that's doing an exchange that allows the accommodator, that would be a company like mine, to come into escrow for the purpose, right? Because Adrian's the only escrow officer in the world that you will ever use, right?
That's right.
That's what I thought I heard.
Right.
Anyway, the bottom line is,
For confirming that.
yeah, thank you. So the bottom line is that for you to bring an accommodator so the seller can do an exchange, you have to have the permission of the buyer. Because the seller and the buyer really have to agree on one thing. You know what that is, Michael? Everything, right? You don't agree on everything, you don't have a deal. And one of the items you have to put into your contract is that the seller's doing an exchange. Now, if for some reason you asked that question and the seller wasn't going to do an exchange, but changed their mind, they can do so as long as it happens before escrow closes. After escrow closes, you know, my youngest daughter just recently got engaged. Of all places, it was her dream to get engaged in front of the fountain in Central Park in New York City, which you've seen a million times in movies. All right? So when I went to New York a few weeks ago, came back, I picked up a term. You know what that term is? Forget about it. That's what they say in New York. Forget about it. If you call me after escrow is closed, the answer is forget about it. We cannot set up an exchange. It's too late. It has become taxable. I had another call today. Same thing. They want to set up an exchange. When did you close? Last October. Sorry, doesn't work. She goes, I'm going to have to pay a big amount of taxes. I go, hey, you should have talked to me. I feel bad about it. What about if escrow closed yesterday? It's too late. Forget about it. Right? The exchange has to be set up before escrow closes. And look, Adrian, she's a wonderful lady. Do not tell her the day before escrow closes in a panic, we need to set up an exchange. You need to be talking and communicating with the seller. And on the 593 form, see if they check that box, that if they want to do a 1031 exchange, we have to keep, because we have to set our documents up in escrow before escrow closes. That makes sense? So make her life a little easier if there's no panic. Would you say amen to that?
Amen.
Now, there's 5 different ways of doing it. I'm not sure that we're going to have time for all 5. Actually, basically, we're going to talk about the main 3. By the way, are there any questions at this point? Nothing? Am I that good of a teacher, or is this boring? Okay. Number 1 is a simultaneous close. I had a call yesterday from an escrow officer in Montebello. And she had a client right there in her office. And he's insisting, because he's going to close his sale and his purchase on the same day, that he does not need an accommodator to do a 1031 exchange. Is that right, or is that wrong?
That's wrong.
It's wrong. You have to have an accommodator to do an exchange, unless it's closing simultaneously amongst 2 parties who are trading.
They're trading
each other, and they have to have language that talks about doing a 1031 exchange. If that's not the case, you have to have an accommodator. So concurrent or simultaneous closing does not mean you don't need an accommodator. It just doesn't. Because in most, 90% of those cases, I'm selling to one party and I'm buying from another and I'm closing concurrently. And that's almost impossible to do because of TRID and CFPB rules. Unless they're two all-cash deals these days. So simultaneous closing, for the most part, you need to do a 1031 exchange. But it isn't simultaneous closing that is leading the exchange market. Number two is leading the exchange market. This is the kind of exchange that most people are going to do. It's called a delayed exchange. And a delayed exchange says that once the accommodator has to set up the documents, like we said, before the sale closes, seller and buyer need to sign. But at the close of the sale, today is September the 4th. So if I close escrow today, beginning tomorrow is day one of 180 days. It is not 6 months. It's 180 days, which is less. The exchanger must close escrow on the new replacement property or properties they'd like to buy no later than 180 days. It's not 6 months, but it's kind of close, but it isn't. Yeah, left time. Yeah, that's true. But you have to close that acquisition. What if the 180th day lands on a weekend?
You need to close before.
You better need to close before, because you can't get to the next business day. Because this is not calendar. I mean, this is calendar days, not business days. What if it's somebody's birthday?
Too bad.
They don't care. Like Martin Luther King, Abraham Lincoln, Jesus Christ, whoever's birthday it is, they don't care. It's not that day, it's before that day, if that's the 180th day. You have to. Can I get an extension?
No.
No. Forget about it. Number two, the government says the first 45 days of the 180 days. So in other words, they both begin concurrently the day after closing. You must name the address of the properties you're going to buy. It's that's what makes them qualified or like kind. They have to be named and on a list of paper or we call it an identification sheet that's submitted to us no later than 45 days after the sale is closed. Those are the only properties you can buy. And you don't have to buy all of them. You can buy one of them, or two or three. We'll get into that in a minute. So the bottom line is that those are the only qualified properties. Now my question is, can I change the list?
Yes.
The answer is 150,000 times. As long as you do it before the end of the... What about day 46?
Nope.
The answer is, well, I guess you can, but it's called tax fraud. So the answer is no. We're not going to do it. You can't do it. It's tax fraud. Is your license important to you? Is your integrity important to you? If your integrity is for sale, you have no integrity. That's the bottom line, right? So the bottom line is you've got to know what you're going to buy. But you said, man, it's too hard. There's not enough listings. I got agents calling me and say, we're back to this thing where there's not enough inventory out there. The buyers are coming out again. This is what you do. Go back to that ZIF form that I talked to you about. Do you know it has language in there? It says that you can extend the escrow if you're not in escrow on the purchase of a replacement property. You can extend your sale. You just have to be a little more specific and tell the buyer when you're negotiating that that your seller reserves the option to extend the escrow once or twice to give them time. And you can say 2 30-day extensions or 1 30-day extension to give them time to get into escrow and clear an inspection. Because once you close the sale, the 45 begins, whether you're ready or not. And my suggestion is you better be ready. in a market like this. Because this goes by far too quick. Listen, isn't the point of selling to create additional cash flow? Isn't the point of selling to re-leverage the equity so you can appreciate better? Isn't the point of selling to buy up to create additional tax write-offs? So why would you wait till closing to start making offers and start looking? You know, I don't know if you know this, but do you know how they teach bank tellers how to discern between counterfeit and the real thing? They don't look at it in a microscope. They don't even look at the prop. They don't even look at the money. You know what they do? They touch it. The more they touch the real thing, the faster they can feel a counterfeit. See, you have to help your clients start touching properties the second you take that listing. Because the key to any 1031 exchange is not selling. It's buying better properties. They're going to cash flow, appreciate, and give you more tax revenue. That's the purpose. Diversification. Not putting all your eggs in one basket. Michael.
So Phil, what I hear you saying is that when you do an exchange, even before you enter into the listing agreement, you need to get a feel of what's out there, number one. And number two, is it a wise idea to maybe get a longer escrow period instead of a 30-day, 60, 90-day? What's your feedback on that?
Well, number one, if it's a seller's market, you're in control. On the sale end, not on the purchase end, but on the sale end. Because the seller has got control. So you got to tell your buyer, I reserve the option to exercise 2 or 1 30-day extension if I need to. If not, I'll drop the contingency. We'll close, because I'm already in escrow to purchase. And you've got to give them some finality. You can't just say, ongoing until I find something. You can't do that. The buyer will walk away. Number two, all these other classes you've been teaching, Michael, cap rates and everything else, you have to be able to start doing that on replacement properties to determine, is this going to be a better buy for me? So all these classes that you've been talking about and teaching are going to be helpful to your clients. You need to educate your clients and begin to start showing them properties in areas that they like. Number three, some are more conservative, some are more chance or risk takers. You have to feel out the mentality and the disposition of your clients. Some may want to re-leverage 20%. Some may want to re-leverage 100% and take on a bunch of new debt. Some are more aggressive than others. You have to feel your client and to know what their expectations and what they feel the most comfortable with. And number three, you have to make sure you have a good lender who can fund that for them. Because if they can't fund that for them, then you're in big trouble. That make sense? Does that answer your question?
Yes.
Thank you.
Okay, you're welcome. So, you have 45 days to figure it out once the sale closes. You can have up to 3 properties on that list and acquire any one or multiple of those properties. Those properties can be anywhere in the country, but they have to be like kind, right? Investment real estate. Some people say, can I put more than 3 properties on the list? And the answer is yes, but the rules change. See, if you put 3 properties on the list, let's say you sold for $1 million. Let's say under 3 properties, you have one is at $1 million, one's at 10 million, and the other one's at 50 million. You can do that. There's no value limit. There's just a limit of 3 properties. The second list is for people who are buying out in the country or other states or agricultural property where the values are a lot lower. They need more than 3 properties on the list because they have to buy for roughly equal or more than what they sold for. So they need a pool of more properties. So the government says, we'll give you that list. That's called the 200% rule. The 200% rule means instead of 3 properties maximum, you can do 4 properties minimum or greater. But you also have to attribute the value for each individual identification. You have to add them all together and the total value of the 4 or 5 or 6 or 7, 8, 9, 10 properties you identify, the total value of all of them cannot exceed more than 2 times what you sold for. So if you sold for $1 million and you want to identify 4 or more properties, you cannot identify more than $2 million because it's 2 times the sales price. That's why they call it 200%. You're probably not going to use that one. In almost every case, you're probably going to use this one. 3 properties. Most clients aren't going to buy it that many. Some do. That make sense? This is a big deal right now. This is called a reverse exchange. See, when you go to leave from here today, you're going to start your engine, and then you're going to put it in R, right? You can back out?
Yep.
Well, R doesn't stand for race. It stands for reverse. Go backwards. The government will now allow you to do a 1031 exchange backwards. What does that mean? That means with the accommodator involved, you can actually close the purchase first and then close the sale up to 180 days after the purchase. They'll let you do it backwards. And that's what a reverse exchange is.
What's the difference in cost?
Tremendous. It's 10 times more expensive on our part because the government makes us go through hoops. We have to set up a holding corporation that's going to take title to the property you're selling the day before you close your purchase. Why does the government make us do that? Because they say you're purchasing first and you cannot sell something and exchange it into something you already own. So we have to take title to the one you're selling, in some cases to the one you're buying, but you can't have title to both at the same time. So number 2, the paperwork goes from this to this. And you'll be working directly with our legal department internally, who is going to be holding your hand and doing all the documents throughout this reverse exchange. So a delayed exchange will cost you in the neighborhood of $750. A reverse exchange is going to cost you $7,000. Let me ask you a question. You know what this is called? Oh, the copy machine's going off. You know what this is called? It's called opportunity knocking. What if opportunity knocked on your door and you found an incredible listing that the seller had to sell and close within 30 days, or for whatever reason? It's in a great location, deferred maintenance, very little, and they're pricing it to sell. It's $100,000, $150,000 global market. Is it worth spending $7,000 for that?
Yes.
The answer is almost every single time. It's worth it. Would you spend $6,000 more to buy the right property? Of course you would.
Yep.
Well, that's just about $6,000 more than a regular exchange. But the key to a reverse exchange is you have to have cash or financing to close a purchase first, because what? You haven't closed the sale. So where's the money going to come from to buy that new purchase? And that's why you have to have a swing loan, a bridge loan, a line of credit, hard money, wherever you can get it. Beg, borrow, steal, whatever. But the bottom line is you got to be able to buy first and then close the sale up to 180 days later. Same rules, just backwards. So when you go in the car and start the engine, you put it in R, think about reverse. Because the government will let you take advantage of opportunity knocking. Does that make sense?
Yes.
Michael?
I think also the real benefit is that I'll spend the $7,000 in order to save me from paying $70,000 in tax
Or more.
or more.
But that $7,000 might buy you an extra $100,000 of equity.
Right.
You know how many times I do that? Every single day. Right? So it's a great tool. Now, don't get me wrong. Would I rather spend $750 instead of $7,000? Of course. But if opportunity was knocking, I could take advantage of it by utilizing a reverse exchange because I don't have time to sell. The answer is I'm going to do it every single time. Yes, sir.
So when you buy the exchange prior to selling, you're gonna buy it cash or bridge loan, whatever, right? So when the sale closes, your company would put the money into that?
What happens is on a reverse exchange, you will be reimbursed any personal cash that you use to float to acquire the property. And if you use swing loan, bridge loan, line of credit, whatever, temporary financing, we can pay off with the proceeds from the sale to pay that off. We can do both.
Excuse me,
That's allowed.
Jose, that was a very good question. Could you speak into the mic and
How's the question?
yeah, yes.
Yes, when you do the reverse exchange and you get funding for the exchange, but you haven't sold the property that you're gonna sell. When you do sell, when the money comes out, does it go directly to the lender? Does it come directly to you? You can put it in your account and leave it there, or?
We work with the escrow company and the title company to reimburse the seller of any personal cash, or the exchanger, any personal cash they had to float, and the lenders of anything that they had to pay off those swing loans, the bridge loan, credit card money, whatever.
So I guess that's my question now. Is there a rule where the money has to go to the lender, or is it optional to the seller?
No.
Can it get reimbursed directly to me and?
No.
It has to
Because
go-
remember, I'm the exchanger, not the seller.
Right.
I'm buying first. So I'm the one who calls the shots based on what I want to make sure that's done, as long as the government will allow that to happen. There's another thing I can do. Only on a reverse exchange, I can do a principal pay down. So if there's extra cash at the end and everybody's been paid, but there's still some extra cash, I can authorize the exchange company to give. That's why you want to make sure that when you buy the replacement property, you don't get a loan with a prepayment penalty. So you can do a principal pay down, and we've been involved in that as well. You can't do that in a delayed exchange, but you can do that on a reverse exchange. Make sense?
Yeah.
That's really huge. That's a very good question.
Excellent.
Anything else?
Can I talk about that?
Yeah, lay it on. Go ahead.
What if the, so if I buy a reverse exchange, if I borrow the money, probably I put points and there's some expenses to the loan, is that, those expenses also get reimbursed to me?
No. The only, remember, it's only the whatever I'm going to talk about that in another slide. Only non-recurring closing costs and anything on an acquisition that goes to the lender is not considered as non-recurring unless I'm just floating money. So appraisal, points, loan docs, they're all considered by the feds as buying a loan. And that isn't real property. That's a trust deed. So the government says nothing like that can be reimbursed to you or taken out of the exchange funds. But only on a reverse exchange, when I have to float money, can I pay them off from the proceeds of the sale? And that is allowed. Does that make sense?
Yes.
Okay, good. Oops, backwards. Let's do it one more time. Now, question. What if I'm selling 3 properties to buy one? Does that ever happen? Oh, you betcha. Your client is selling 3 properties, but they want to buy one major, big, large property. Well, I could use a delayed exchange where I close the first sale, and the government says that after the first sale closes, I have 180 days to close what I'm going to buy. Which means I got to close the next 2 sales sometime before the purchase closes, right? If I can close property number 1, property number 2, property number 3, and the acquisition has to close 180 days from the first sale closing, with a 45-day identification to determine that address. Government says that's not a problem. But you're not so lucky. You close property number 1. You close property number 2. You identify the replacement property and you're able to close it, but you can't close the third sale on time. What happens?
Oh,
The government will now let you do a hybrid exchange. Does anybody have a hybrid card that runs on gas and electric? Well, you know how a hybrid card does both? Well, hybrid exchange, the government says on property number 1 and property number 2, you will acquire in a delayed exchange. But since we know, because we're talking to the client, that property number 3 is not going to close in time, we're going to also set the purchase up as partial delayed exchange and partial reverse exchange. So they can float some money to acquire the entire replacement property and then close the third sale up to 180 days later. Isn't that cool? So now you're talking 7,000 plus 750 plus an extra 500. The price goes up. But is it worth it? To them, it probably is, because they want to combine 3 sales into 1 purchase, and it's a lot less expensive to do that than to pay taxes. And it works. The government actually blesses it. Hybrid exchange is pretty cool. I want to talk about this real quick because we're running out of time. Build to suit. I don't want to really actually talk about this exchange. I want to talk about what you can't do. I had a call this morning. Phone's been very active this morning. And this lady calls me up and says, my seller for my client, my client is the buyer. They're doing the 1031 exchange. We've already closed their sale. They're going to close their purchase now. And there's some things wrong with the property they want to buy. They want to give them an $11,000 credit to fix those things so the buyer can get them fixed after the buyer acquires it. Is that allowable? The answer is no. It is, but you'll pay taxes on the $11,000. You can't use money from the sale to fix up the purchase after you buy the purchase, because it automatically becomes taxable the second you close the purchase and it did not go into the actual acquisition of the purchase. Does that make sense? So I said to her, another way of doing this without paying taxes on the $11,000 is to have the seller lower the purchase price by $11,000. And that would be helpful. And then later on, after they acquire the property, get a second or something, or a line of credit, fix up the property. It's actually less expensive to do it that way. This exchange is called a build to suit exchange. And we don't have time to go over all the details of it today. But basically what it allows us to do as the accommodator is to help them close the sale and then close the purchase, but the client doesn't take title to the purchase. We do. So let's say they sold for $1 million and they bought for $600,000. We take title to the $600,000 property. With the remaining $400,000, they can have the builder or the contractor fix the property or build on the property that we'll use the rest of the $400,000 with. So at the end of the 180 days, we're going to deed this property that they bought for $600,000 and put $400,000 of improvements in, so they bought for equal or greater than what they sold for, and then we'll deliver title to them. That's what a build to suit exchange is. And I just covered the tip of the iceberg. It's really a lot of work, but it's doable. It's actually costs more than the reverse exchange. But this is good for some people or companies that need to do this. Now, I want to spend a little time on this slide. This is a very important slide. So I want you to ask me any questions, because I really want you to get this. Number 1, the investor must reinvest all the cash from the sale. Remember I said you can't put it into improvements afterwards? It has to go into the actual purchase, or acquisition of that purchase. If there's money left over of any kind, the difference is called boot. It's taxable. You can do a partial exchange and pay some taxes. So if you buy down, you're gonna have cash left over. If you withhold some cash for personal reasons, whether it's fixing the property or going on a vacation on a cruise, it's taxable. That doesn't mean the exchange is over. You still do a 1031 exchange. It just means any cash that doesn't go into the actual purchase of the property is taxable. Call it a partial exchange. Okay, number 2, the investor must what? Reborrow on the new purchase no less than what was paid off on the sale. What does that mean? At the close of an escrow, the title company will do what we call the payoffs based on the demands that the escrow officer received from all the lenders and liens against the property. Those have to be paid off. So whatever, if I sold for $1 million and I had $400,000 of cumulative payoff, first a line of credit, a second, a HELOC, whatever, the total payoff of debt is $400,000. It has to be paid off, but then on the purchase of the new property, it must be reborrowed again. You cannot have debt relief from the sale to the purchase. It's very important. Your client has to be in a position to either reborrow the 400, or if they can't or don't want to, they can pull cash out of their bank account and put it into escrow as a replacement to the payoff. So they don't have to reborrow because they brought in new cash instead of reborrowing. Most people won't do that. Yes?
Is it principal plus any interest and charges, or just the principal?
Principal payoff, including
Just the principal balance?
and interest. Yeah,
Plus interest?
yeah,
Okay.
but that can be replaced. Because that is the payoff. It's principal and interest, right? So the bottom line is, new cash can be substituted to acquire the new property instead of a loan. But most people are going to want the loan, and what we've been talking about is releveraging. So you don't want to put more cash on the property. It doesn't make sense. You want to diversify more. That's how you make more money. But the bottom line is, I want to talk to you about this problem we're seeing out there. Guess what lenders sometimes do? They pad the loan to be a little bit more than what the client needs to borrow. And it comes back to the buyer, which is the exchanger, in the form of a check. It's taxable, it's boot. You cannot overborrow and take cash back. The government says you can't touch cash at all when you do a 1031 exchange. If you do, it doesn't disallow the exchange, but you pay taxes on it. So really, an exchange is nothing but the movement of cash into the acquisition and the replacement of debt into the acquisition. So I'll give you an example. If I sell for $1 million and I have a payoff of $400,000, that leaves me $600,000. But I also have non-recurring closing costs. What are those? The costs I have to pay to sell the property. I have to hire one of you. I have to hire escrow. I have to hire a title company. I have to pay transfer taxes to the county, in some cases to the city. I have to pay an accommodator, recording fees. Those are all costs, one-time costs to sell. Property taxes, insurance, those are not one-time costs to sell. HOA fees, not one-time costs to sell. Only one-time costs to sell. Non-recurring closing costs can come out of the proceeds of the sale. Let's say that costs me $70,000. $1 million minus 70,000 equals
930?
930. 930 equals the cash that's coming out of the sale plus the debt replacement. So if I sold for $1 million, I really can buy in this example for 930 because I'm allowed to take out of the proceeds of the equity the non-recurring closing costs and pay those off. Now don't tell your client that. Tell them if they sell for $1 million, they should buy for $1 million. You'll confuse them, and then you're going to call me. And I'm happy to talk with you. But the bottom line is, the non-recurring closing costs can come out. So what if Michael is my agent? And Michael lists and sells the property for me, and he said, but before he does that, he said, Phil, you know, your property is a piece of junk. It needs rehabbing. There's dry rot, there's plumbing issues, there's electrical issues. So I say, okay, let's fix it up. So we do. Cost to sell. Is that a recurring cost to sell, or is that a non-recurring cost to sell? It's recurring. It's just maintenance of the property, folks. I should have been taking care of that. That's what I normally would do if I wasn't selling. But what if Michael comes up to me and says, fix the property, we'll take care of it, we'll have escrow pay you back. And the deal is that I'll take the listing, and I say, no, Michael, I'm sorry, you sell it as is. Can I do that in California?
Yes.
Yes, but I have to do what? Disclose. So I do. And of course, he comes up with an offer, and the offer is an incredible offer, and he shows it to me, but they're asking me to fix the same stupid things he asked me to fix once upon a time, right? And I say, okay, let's just either credit the buyer, or let's just fix it and get it done and over with. I got a good offer on the property. Is that a recurring or a non-recurring closing cost?
Non-recurring.
Now it's non-recurring because it is now a contractual condition of sale. Anytime something becomes a contractual condition of sale, and I agree to it with the buyer, it becomes non-recurring. But if I fix it up before I have a buyer, before I have a contract, it's recurring. I have to take care of it myself. Does that make sense? Yeah. Only non-recurring closing costs can come out of the proceeds of the sale. So to wrap things up, why will I eventually pay the taxes? The answer is yes, if I cash out. But you see, as I get old and gray, as you can tell, what happens is I want to go into other properties that I don't have to babysit anymore. Maybe a triple net. Maybe I'm going to buy a Taco Bell. Maybe I'm going to buy a Starbucks. Maybe I'm going to buy a property that one of these types of Trader Joe's is going to lease from me. I don't babysit them anymore. They produce income. They're triple net. So they pay for everything, right? That's one of your classes. And then eventually I'm going to die. And it's going to go to my heirs, whether it's my surviving spouse or my children. Do they pay the taxes if they sell the property? The answer is, it depends. See, if I had it in a trust, or if the property was owned by an LLC, and the trust owned the shares of the LLC, the government says my heirs get a stepped up basis. Remember our basis that we were talking about at the beginning of today? Well, that basis gets stepped up to the fair market value at the date of my death because I had it in a trust. Which means if I bought it for $300 and it's worth $3 million when I die, they get it at a basis of $3 million. They sell it for $3 million, and guess what happens? They pay zero in taxes. You know what we call that in our industry? Swap till you drop. The whole point is to keep exchanging, keep releveraging, keep making these properties and their money work for you so you don't have to. And real estate is the best way to do it, in my opinion. I think my time's up. I have marketing materials I can make available at another time. Michael can talk with you about that because you need to get in front of new people, because the bottom line is your lifeblood, your ability to breathe is going to be based on your meeting new people every single workday. We could talk about that another time. Thanks for having me here today. I hope this was helpful. Call me if you have any questions.
Awesome. Every time I hear Phil talk, I get excited all over again. So I want to ask Phil a question.
Yes, sir.
Phil, would you mind coming back to, I know we kind of rushed you, so we want you to just kind of finish up and then talk about the marketing.
I would love to.
About how we could actually get in front of people and actually get this thing
You
going.
take me out for lunch and I will do all the talking you want.
Today. I will take you out today. Okay? All right. So thank you very much for joining us. If you have any questions for Phil, he's going to stay a little bit longer, and it's been awesome. We appreciate you, and we'll be seeing you guys next time. Thank you.